Hello everyone, happy Wednesday afternoon. Welcome back to another edition of #askrobco. Hope you're all well, safe, hopefully healthy in the interesting circumstances that we all find ourselves in. Very quick update today, probably 15 minutes. So I want to jump straight into it. Everyone knows how it works. Loads of you have been writing to me offline with your questions and queries and how you want the show to work every week, the information you want to hear and want to see. So thank you for that. We will make all the adjustments as possible. Any questions you've got today, on the right hand side, questions tab, write question, and we will hopefully be able to discuss the point that you've raised. Welcome, James, just joined us. I'm going to go straight into the data for this week, just to give you a very quick update. 5th of October, if you open 29-week post-lockdown in the handout section on the right-hand side, you will see our latest data sheet. And it's really a continuation of the last 2 weeks. So now we're 3 weeks in a row where broadly the amount of instructions that are coming on stream are broadly the same in the 500s. The amount of deals that are going through are broadly the same around the 180 figure, and very consistent market flow. Instructions, properties under offer, and properties exchanging or being sold. Very similar numbers, very consistent. We're now 3 weeks where the numbers are pretty much the same, and I think it's very positive because we're not seeing crazy outliers now like a month ago with the record volume of properties coming on stream and some peaks with sold figures with the pent-up demand that we had seen. Now we're seeing week after week after week very consistent numbers of properties coming on that are relating to sales, proceeding, exchanging, being sold. So 3 weeks in a row, the data is very consistent and very solid. Now, more importantly, what are we seeing live on the ground? And a few of you have contacted me in terms of what's the valuation space looking like. People are experiencing challenges in terms of turnarounds, in terms of access, in terms of availability. And this is a challenge that we probably haven't discussed in the last 4 or 5 weeks, maybe a little longer. Remember, I built you that 4-phase market return in terms of pent-up demand, huge volume coming on stream, and delays and timings to allow that to all feed through. Well, now that has all happened, I suppose what we're seeing now is unprecedented volume of work, which is coming through the refinancing, the remortgaging, the transactions that are going through, the equity or further advances that are taking place. So the valuation marketplace is inundated, which means a lot of the banks, a lot of the lenders, a lot of the panel managers are struggling to get the valuers in and the turnaround as quickly as they'd want to be. This is a tremendous challenge on the market. It's a tremendous challenge on the valuation industry as surveyors and valuers. From our perspective, obviously, we're not a mass volume factory-led company, so we are able to manage our volumes extremely well and service our clients, I would say, in pretty normal levels and conditions, very consistent. Simultaneously, I appreciate that you're facing the challenge, all of the lenders and the risk and the credit and the sales teams on the call, you're facing the challenge of not getting your reports back, not getting the inspections made, and not getting in the turnarounds. And that isn't going to change probably for the next few weeks at least. The question mark is obviously that with the pandemic and the levels of uncertainty now that is coming into the economy and the workplace, there are concerns about whether inspections could be affected again, unlike they were previously. And so there's even a greater demand to get more done quickly as soon as possible. So I think that's something we all need to be aware of. I'm very much hoping that whatever the second wave lockdown looks like, it won't affect directly us being able to inspect properties. At the same time, we have to be aware that it could make those inspections more challenging when you're dealing with HMOs, multiple occupation, and maybe buy-to-let properties with families or more than one person living in the property. These are all the challenges that we faced when the market reopened, and now we could face them with unprecedented volumes of work on the back of the high levels of 13 high year levels of mortgage applications that have been approved that we discussed a few weeks ago. And when those figures come out in the next week or 10 days, I believe that we would see 15, 20 year record 100,000 plus approved mortgage applications, which is filtering through into the valuation market, which again is leading to this pressure on accessibility, availability, and turnarounds. James, anything you want to add on that?
Yes, thanks, Rob. I just wanted to sort of further underline.
Technical problem, James. Can't hear you, James.
Any better now on the audio?
Yeah, really good. Thanks, James. Sorry.
Okay, no, thank you for that, Rob. I think the data that's highlighted through September now into October remains positive, which is obviously sort of tremendous news for the segment, and also brings sort of positive sentiment to the market. I just wanted to touch on a report by Knight Frank, which was released just this week, that so far in 2020, in the first 8 months of the year, there's been reportedly £1.13 billion spent on 10 million plus transactions alone here in London. And this is 16% higher than the entirety of 2019. So obviously underlines some of the key deals which we've been bringing you over the last few months, some over 100 million, some super prime deals, which are only really now sort of being collected in that data and reported.
Yeah, absolutely. And I think we've been really on the pulse every week, giving you those numbers, giving you those figures. I have to repeat, unprecedented volumes of valuation work taking place. And I know that we represent most of the lenders in the UK in the various segments of bridging, challenger bank, commercial banks, high street retail lending, and private banking. And I know a lot of you are reaching out, have asked me the question, how do we get the turnarounds? How do we get people in? We're under tremendous pressure. I just don't have the perfect answer for you. All I can share with you is relatively our turnarounds and the consistency of what we're producing is probably on a par with normal times. But I completely understand that some of the panel managers are running 4, 5, 6 weeks time delays because of that unprecedented volume. I just don't have the answer. Happy to have separate conversations with those of you that have reached out to discuss that matter. For all the credit teams that are on the call, if you want to share this with the credit teams and the risk teams, I'm going to be sending out paper to most of our lenders on a bit of risk guidance. Actually, it will go to all the lenders we operate with and the panel managers, because we are now seeing this off market, frothy, hot market, loads of transactions taking place, loads of people paying either premiums or over the market price. And I just think a guidance needs to go out for risk and credit, not to dampen the momentum and the spirit of the market, absolutely not, but so your credit sanctioners understand what the transaction means and what it looks like. And this, now we've got two areas. You've got the refinance that are jumping on the back of premiums being paid for transactions going through. So maybe getting slightly artificial pricing to maximize and leverage. That's a warning sign, and that's what the risk paper that I'll be sending you is going to discuss. And also, to reiterate the previous point of premiums on purchases, again, you've just got to build that into your risk and your sanction where that happens. And I'll let you know about that on the risk and guidance that I'm going to be sending to you. So all of the credit, risk and sanction teams, if they're not on the call and you want to share the call with, please do. If you want to share the note that I'll be sending you, then also do that. James, anything on premiums and slightly inflated or frothy market figures you want to add that I've missed there?
Yeah, just wanted to underline the point really, Rob. For instance, in the past few weeks, all of the purchases which I've been able to see have all been very close to at or even above asking price. Earlier this week, I was in Brackenbury Village seeing a house. It was a probate property. It's gone over 15% over the asking price, with the property going to sealed bids. The market remains to be really, really hot at the moment. That particular house ticked a lot of boxes. It had sort of potential to extend. It had a large garden, exactly what people are looking for in this current market. I did have some news also of a possible super prime deal at the moment as well, just in the northwest corner of Regent's Park, at sort of America's Corner. Winfield House, which is set in around 12 acres of land, which is where the American ambassadors reside. The lease on this is due to be sort of renewed at some point and could drive a sort of record-breaking price. We're not sure if any sort of official prices will be released on that, but as you can imagine, it's the second largest private garden in London, only behind Buckingham Palace. So another sort of super prime, sort of maybe not arm's length transaction, but something that's in the offing at the moment.
Sounds good. Sounds really good. Thanks for that, James. Back to credit and risk. We've received some really good guidance this week from Nationwide that have updated their guidance notes. EWS1, that continuous theme, few changes from their perspective. And I always think that Nationwide are a market leader in that sense, just because of pure volume that they cover in the country and the market share that they have. So really, some really good guidance there. And I know, again, quite a few of you have been reaching out because of inconsistencies, both from the market and from lenders and from valuers, about the approach to certain types of properties, certain height limits involved, properties that are being declined where maybe it's perceived that they shouldn't be. We're getting lots of issues and challenges there, and I do think that the EWS1 update from Nationwide is a really good piece, and I think it generally they do set the market position, and so some really good stuff there. Also, there's some new regulation that's coming in next year from the EBA in terms of reviewing your back books and your historic lens. And this is something that we've been working with quite a few of the banks, quite a few of you on the call, is that looking at your 3-year reviews on historic lendings in line with the new guidance that's coming in July 2023 21 from the EBA. I will be sending you all the guidance notes on that. That's really, really important. I know it seems like a long way away and it's not your biggest concern, but where you're running commercial and residential back books of lending and portfolio over and above certain amounts, there is going to be a requirement for internal external independent or internal independent updates, depending on which way you want it to be managed. And so I will be updating you on that and giving you some guidance and advice on that. I think that's really important. And now is a great time to be doing that because of the uncertainty of the market and the volatility that we're seeing. It's a great opportunity to understand what your book looks like in accordance with the regulations and the governance that's coming in. The next point I wanted to add and discuss is had a nice call with one of our regular viewers yesterday, and we were trying to discuss and understand the sentiment of the market being so positive with so much volume across the entire country at all price levels. And really the consensus is the following, and it's something I keep repeating, but it's a common sense viewpoint to understand what we're seeing. Where sentiment from Mr. Investor or Mrs. Homeowner is that debt is cheap and the opportunity to refinance or purchase and secure 5, 10, 15, 20 years of very, very cheap debt and leverage their income, both commercially, high levels of income stream, or high levels of income and bonuses on personal income, now is perceived as the opportunity to make that transaction and trade because of the uncertainty of what that income stream will look like in 6 to 12 months, both commercially, whether it's an HMO or a buy-to-let, because rents are coming down, being driven down, and at the same time, what your job security and credit worthiness is like or going to look like. So it's that sentiment and pressure to either upgrade, refinance, buy the new home that has the better conditions and position you got now that's driving the market, along with the stamp duty window. The combination of all of those variables and factors, along with the sentiment of the uncertainty of what it might be in 6 to 12 months, is driving people to follow the path that James has just mentioned, where you're getting 15, 20 people go to a property, bidding it up 5, 10, 15% over the asking price, happy to pay the premium, because what they're going to pay by overpaying on their 600,000 or 1 million purchase is less than what they're currently paying on their 400,000 or 800,000 property before the upgrade, because of the cheap debt and the leverage opportunities that are still available and the long-term view of making that move and the upgrade. That is the market sentiment. I know many of you keep on reaching out to me and saying, Rob, I don't understand. Why would the market be so crazy? All of you were asking the questions during lockdown. What am I shaving? Am I shaving 5%, 10%? What is everything being renegotiated downwards? What should our risk appetite be? All of you were asking those questions. Literally, we're 3-4 months away from that moment, and now we're seeing 3, 4, 5%, and James's example, 10, 15% over and above, and suddenly the whole risk position is being flipped upside down, but still just as important and just as pertinent. Why? Because if someone is paying 10, 15% over market value now because of the sentiment and the rationale and the reasoning I've just given, if in 6 or 12 months the market isn't in that place, and maybe it softens for whatever reason, because maybe economically things don't go as well, then suddenly there's going to be a gap. And if that gap reaches 30% or 40%, many of you are lending on LTV coverage of 70, 80, and obviously we know there's a 90% product out there, suddenly you could be in potential breach. So actually, we've got to be aware of that now. I don't know if you want to add anything, James.
Yeah, no, thanks, Rob. I just wanted to further say that across a lot of the residential sectors, there really is positive sentiment. You've got sort of the entry level first-time buyers, of which there's much demand at the moment. There's obviously the stamp duty holiday at the moment up to 500,000. There's the new government incentives for the 95% mortgages, which is an emerging product. You've got the HMOs buy to let, which we're seeing a lot of purchases and transactions there. Again, in that sector, we've got build to rent, PRS, with firms bringing schemes out the ground to house a lot of those in London. We've got people moving out of London, wanting larger houses, which is fueling the sort of steps up the property ladder. We've got the country market, people moving out of London, the new sort of found commuter belts, obviously the super prime deals we're bringing you. So really across the residential sector, there's much good and positive sentiment.
Thanks, James. Just to close out for today, and I want to reiterate, because I know a lot of you who are here, I know your roles, I know your positions, I know the intel and content that you want to hear. I always repeat risk v sales, and it doesn't mean one is better than the other. That's the world we live in. Heart for the risk and dollar for the sales. Now, we went through a period, 2 or 3 months, where nothing really could happen because we were in lockdown. Now we're out of lockdown on a pent-up demand, positive market, like James is saying, and sales are driving. So a lot of you on the call are representing sales teams that have huge volumes going through at the moment. Happy days, really good. And the reason why they've got huge volumes is because sentiment is good, but also because they have to make up for the lost sales of that 3-month period. The year is closing out. Everyone has targets. Every bank is driven to reach their goal of lending and targets. And that's the way they operate. And it's completely normal and completely fine. So sales are being driven. Targets need to be achieved. Unprecedented volume, as I said, from the private banks, from the retail lenders in this country at the moment. We're seeing a supply from the demand really unprecedented for many years, and in the special commercial areas of your HMOs market, very buoyant. So sales phenomenal in those hotspots and areas, and it's for the risk and the credit and the sanction teams to understand the challenges that we're going to face over the coming months and the red flag risk areas where you need support and guidance to manage the risk of that huge volume and supply that you're putting out into the marketplace with your sales. So that's what we're here for. I will definitely get out to you those 2 documents, one, the risk paper on the current lending and the guidance note on that. Secondly, the new regulations on your historic and current lending books from the European Banking Authority, where we can give you further guidance on that. I'll get those papers out to all of you. And please do reach out to us with all the other questions and queries that you have, or all the information you want to hear within the weekly webinar, so that we can touch on the pertinent points that you are raising specifically to get better answers, better intel, better content, and so that we can add value on a weekly basis. Anything else you want to add before we close, James?
That's it from me today.
Brilliant. Thank you so much for everyone reaching out. So many of you have reached out with questions. Thank you for the content that we're providing. We agree, we don't agree, but we love the added value that you're providing. We're here to service you. You are the marketplace, the 100+ lenders and banks that are on this call, both live or watching on YouTube and engaging through all the other platforms, Instagram, LinkedIn, etc. Thank you so much, because this is for you. We're creating this platform for you, and it's our job to give you live intel, content, and add value. Everyone stay safe. Everyone stay healthy, and we will see you at the same time, same place next week. Take care, everyone. Thanks, James.
Thanks, everyone.